What your shop floor is saying about your business. Before anyone seriously considers an acquisition, they're going to walk around your shop floor. And in about 10 minutes, they're going to form an impression that's very hard to change. I've been in a lot of shops over the years, both as a business owner and as an advisor, and the floor tells you something that the numbers sometimes hide. A well-organized shop where tools have a place, materials are labeled, workflows in one direction, and the bathrooms are clean signals something important. It says this operation is run with intention. It says the owner pays attention to details. It says that what you see in the financials probably reflect what is actually happening. A shop where you cannot tell finished goods from scrap, where the same job has been sitting in the same corner for 6 months, where nobody can find the inspection records, that shop signals something too, even if the numbers look good on paper. Buyers, lenders, and advisors are pattern recognition machines. They have seen a lot of shops. They are making judgments constantly, often before they're even conscious of it. Condition of your floor either confirms the story your financials are telling or it creates doubt about it. The investment required to address this is mostly time and discipline, not money. A cleaner, more organized, better labeled operation is something you can build over the next 6 to 12 months, and it will change the first impression your business makes on everyone who matters. I'm Brent Pennington with Metroport Industrial Advisors. I've spent 35 years running businesses like yours. Follow along. These are the conversations I have every day. How old is your equipment and why does it matter? Walk through your shop and look around. How old is your oldest piece of critical equipment? When was it last rebuilt or recalibrated? Is there anything on that floor that you've been nursing along because replacing it never made it to the top of your priority list? Most owners know the answer to those questions immediately. Here's why they matter beyond the day-to-day. When someone evaluates your business, your equipment is part of what they're buying, and the condition of that equipment tells a story. Well-maintained machines with current service records say that this operation has been run with discipline. Aging machines with deferred maintenance says the capital has been pulled out of the business instead of reinvesting in it. There is also financing dimension that most owners do not think about. Many buyers of small manufacturing businesses use SBA financing. Lenders want to see that the equipment supporting the revenue has useful life remaining. If your shop is full of fully depreciated machines that are only one breakdown away from a major repair or obsolescence, that affects how a lender may see the deal, which affects how many buyers can actually get to closing. This is not about having brand new equipment. Plenty of great shops run older equipment that is well maintained and fully capable. It's about knowing the shape of your equipment and addressing the gaps before someone else identifies them for you. I'm Brent Pennington with Metroport Industrial Advisors. I've spent 35 years running businesses like yours. Follow along. These are the conversations I have every day. The customer concentration problem. You built your business by taking care of your customers, and chances are a handful of those customers have been with you for years, maybe decades. They trust you, they pay on time, and they keep coming back. That loyalty is something to be proud of, but here's what I want you to think about today. What percentage of your total revenue comes from your single largest customer? If that number is 20% or more, you have what is called customer concentration, and it is one of the first things anyone evaluating your business is going to look at. It is not that the relationship is bad, it is that the business carries risk if that relationship ever changes. Customers get acquired, purchasing managers get replaced, contracts get rebid. It happens even to shops that did everything right. The question is not whether your best customer is loyal, the question is whether your business can absorb the loss if they choose to leave. A business where the top customer represents 40% of the revenue is going to be valued differently than one where the top customer represents, say, 12%. That gap shows up in price, in deal structure, and sometimes in how many qualifying buyers are willing to move forward. The good news is this is something you can work on. Not overnight, but over time you can grow your second and third tier customers or add new accounts. Reducing the concentration percentage is one of the higher return investments you can make in your own exit. I'm Brent Pennington with Metroport Industrial Advisors. I've spent 35 years running businesses like yours. Follow along. These are the conversations I have every day. Understanding the value of your business from a buyer's perspective, the difference between revenue and value. I talk to manufacturing business owners who tell me that their business does a certain amount in revenue. Then they ask me what it's worth. The honest answer is that the gross revenue factor is not the most important number in that conversation. Here's what I mean. Two shops, both doing $3 million a year in revenue. Shop A has 45% gross margin, recurring customers, a shop manager who runs the floor without the owner present, clean financials, and a 5-year lease business with 2 renewable options. Then there's Shop B. They have a 35% gross margin, 3 customers who represent 80% of the revenue, an owner who is the only person who can quote jobs and set up the machines, and their lease expires in 14 months. Same revenue, completely different businesses. Shop A is going to generate significantly more cash after paying the bills. It is going to transfer more cleanly to a new owner. It is going to qualify for better financing, and it's going to attract more buyers. Shop B has real risk embedded in almost every dimension of the operation. The value in a manufacturing business is driven by how much free cash the business generates for the owner to use, how consistently it generates it, how transferable it is to someone new, and how much risk a buyer has to absorb to get there. Revenue tells you the size of the operation. The rest of the equation tells you what it's actually worth. I'm Brent Pennington with Metroport Industrial Advisors. I've spent 35 years running businesses like yours. Follow along. These are the conversations I have every day. Understanding the value of your business from a buyer's perspective. What gross margin is telling you. If there's one number I want every manufacturing business owner to know cold, it's their gross margin. Not revenue, not net income even, but gross margin. Here's the simple version. Gross margin is what is left after you subtract your direct cost, materials, direct labor, and the cost directly tied to producing your product from your revenue. It is expressed as a percentage. A job shop or machine shop typically runs about 30 to 55%. A service business might run higher. A distributor might run lower. These ranges exist for a reason, and when a shop falls outside of them, it's a signal worth paying attention to. You can find benchmarks for your industry at Risk Management Association or with your industry trade group. If your margin is lower than it should be for your type of operation, one of a few things is happening. Your pricing may not be capturing the full value you are delivering. Your material costs may be higher than they need to be. Your direct labor may be carrying inefficiencies that has not been addressed. Or your job costing system may not be accurate enough to tell you which jobs are making money and which ones are not. The last one is more common than most owners want to admit. If your gross margin is higher than expected, that is usually good news. But it is worth understanding why, because sometimes it means costs are being miscategorized, and that will surface during due diligence. Knowing your gross margin, understanding what drives it, and being able to explain it clearly is one of the marks of an owner who has their house in order. I'm Brent Pennington with Metroport Industrial Advisors. I've spent 35 years running businesses like yours. Follow along. These are the conversations I have every day. Understanding the value of your business from a buyer's perspective. What is a recast financial statement? Most manufacturing business owners do not know about recasting financial statements from EBITDA or NOI until they start the exit process. The financial statements your CPA prepares every year are built for one primary purpose: to minimize your tax liability. That is their job, and they're good at it. But those same statements without adjustments are a poor way to show what your business is actually worth. Here's why. As a business owner, you run a lot of legitimate expenses through your business. Your vehicles, maybe your reasonable but not necessarily essential travel expenses, or maybe a family member or two that are on payroll. It may be depreciation on equipment you bought years ago, or a one-time expense that you're not going to repeat. They're all real, legal, and appropriate, but they reduce the income your financials show, and income is what drives value. A recast financial statement, sometimes called a recasting or seller's discretionary earnings calculation, adds those items back. It starts with your reported income and works back up to show what the business has actually generated for you as the owner before those discretionary and non-recurring items are taken out. In larger firms, we begin with the EBITDA and work a slightly different process. That number is a much more honest picture of what a new owner stepping into your shoes would actually earn. The difference between your tax return income and your recast income can be significant. I have seen it change the conversation about value by a substantial amount. Understanding this before you go to market is not optional. It is the foundation of every valuation conversation you are going to have. I'm Brent Pennington with Metroport Industrial Advisors. I've spent 35 years running businesses like yours. Follow along. These are the conversations I have every day. Understanding the value of your business from a buyer's perspective. How manufacturing businesses are valued. When the conversation about selling your business gets serious, you're going to start hearing terms that sound more complicated than they are. Let me me give you the plain language version. The most common valuation method for a small manufacturing business is a multiple of seller's discretionary earnings, or SDE. SDE is the recast number we talked about in the last episode. The multiple is a number, typically between 2 and 4 for most small shops, that reflect how attractive and transferable the business is. A higher multiple means less risk, more recurring revenue, stronger systems, and less owner dependency. For larger operations, you'll hear EBITDA, EBITDA, which stands for earnings before interest, taxes, depreciation, and amortization. It is similar in concept but used for businesses with more management infrastructure, where the new owner is not necessarily working in the business every day. There is also asset value, which matters in businesses where there is little to no profit, and the equipment, inventory, and real estate represent most of what is being purchased. Some manufacturing businesses, particularly older ones with lower profitability, are valued primarily on their assets rather than their earnings. In practice, most deals involve a combination of these methods. The earnings approach drives the headline number. The asset approach may set a floor. The final price reflects negotiation, deal structure, and how motivated both parties are to getting to close. Knowing which method applies to your business and roughly what range your operation falls into puts you in a much stronger position when those conversations start. I'm Brent Pennington with Metroport Industrial Advisors. I've spent 35 years running businesses like yours. Follow along. These are the conversations I have every day. Understanding the value of your business from a buyer's perspective. What kills value in a manufacturing business? Most manufacturing business owners are surprised when they find out what their business is actually worth, sometimes pleasantly and sometimes not. The gap between what an owner expects and what the market will pay usually comes down to a handful of specific issues. And the good news is that most of them are fixable, at least to some extent, with time and intention. Here are the 5 most common value killers I see. Customer concentration. When 1 or 2 customers represent the majority of your revenue, buyers see fragility. Diversifying your customer base over time is one of the highest return investments you can make. Owner dependency. If the business cannot function without you in the middle of it, the value of what you've built is tied to your continued presence. That is a problem for anyone trying to buy you out. They are really just buying a job, but without your experience. Deferred maintenance. Aging equipment, a deteriorating facility, and deferred capital investments tell a buyer that the business has been generating cash at the expense of its future, and that gets priced in. Weak or inconsistent financials. 3 years of clean, consistent, well-organized financial statements is the minimum. Gaps, inconsistencies, or financials that cannot be explained clearly erode the confidence. A short or unfavorable lease. If your lease expires in less than 2 years and you have no renewal options, that is a real problem. Your location is part of your business. An uncertain real estate situation creates uncertainty about everything else. Now, none of these are fatal if you have the time to address them. All of these are costly if you wait until the last minute and you're ready to sell. I'm Brent Pennington with Metroport Industrial Advisors. I've spent 35 years running businesses like yours. Follow along. These are the conversations I have every day.